Welcome back to the Kudlow Report. I'm Larry Kudlow. All right, Q4 GDP came in light, 2.8%. People were thinking 3.5 to 4. Stocks wound up selling off on the news. And interestingly, one of our panelists actually sees a serious recession risk ahead. So let's talk. We have Lee Munson, Chief Investment Officer at Portfolio. CNBC contributor Don Luskin is Chief Investment Officer at Trend Macro. And on the CNBC Newsline, we have Jim LeCamp, Portfolio Manager at Macro Portfolio Advisors. Don Luskin, I was terribly interested to read in the notes that you see a serious recession risk ahead. Tell me about that, and what's that mean for stocks?
Well, this isn't new, Larry. I've been saying this for quite some time. The macro data that we see doesn't show any signs of recession, but over 30 years of being in this business, I've found one indicator that is flawless in forecasting business cycles, and that is S&P 500 forward earnings. When year-ahead earnings start moving down, in other words, when they're being downgraded on average, not upgraded on average, that means that a recession is anywhere from 3 to 9 months in the future. And the peak in forward earnings in this cycle was last August. So we are getting there.
Let me just cross-examine quickly. How big is the downgrade, Don?
The downgrade is only about 2% so far in the U.S. In other countries, it's massive. You know, we're looking at 17, 18% downgrade in Italy, 10% in Germany. You know, obviously Europe is already in recession, so in the U.S. it's small, but in certain key sectors it's gigantic. So forward earnings in the financial sector are already down 10%. That doesn't mean you're going to get a big recession. It doesn't mean you're going to notice that you're in a recession.
But
I'm not saying that.
Bearish for stocks. It's got to be really bearish for stocks.
No, Larry, it doesn't, because whether there's a bear market or a bad one associated with a recession is a question of valuation, not a question of business cycles. There was no bear market associated with the 1990-91 recession. Stocks were up during the whole thing, whereas in the 2001 recession, which was a very mild recession, there was a 50% bear market because stocks came in so overvalued. Stocks are so cheap right now, don't worry about the business cycle.
All right, I'm paid to worry, but I want to go to Lee Munson. In your notes, you say you don't see a recession threat. In fact, you see 4.5% growth.
You know, I do, and you have to remember, 4.5 is just trendline growth. We're still not going to get, maybe 5.5 or 6 that we would need to really jumpstart, the growth that I know, Larry, you like to see. But I don't see a recession. Now, I will agree with Don on some side that I don't expect any more than, say, 0 to 5% increase in earnings on the S&P 500, and I do think it's a matter of multiple expansion. But we also saw last quarter we did take in, a 1% haircut because of government spending getting taken out of nominal GDP, but we also saw residential construction up 10%. So we are seeing signs of life in housing, and we've had 4 quarters where that residential side has really made a positive impact on GDP. So I don't think we're quite in recession territory. I think that we're going to grow just fine. I think we're going to be okay this year.
All right, let me go to
Jim. There's one thing in this morning's numbers, Lee, though, that you really have to acknowledge, and that is so much of the real growth report today, 2/3 of it was in change in inventories. And when that happens, that means you're just going to have to give it back in the next quarter, because inventory changes over time always have to sum to 0. So you have a big one in one quarter, you get a negative one in the next quarter. That's just history. This coming quarter isn't going to be great.
I agree that we could have some spillover from last quarter, and I did think that it was pretty shocking that right year-end inventories and the numbers that you're talking about, but I still think in the second half of this year, we're going to go back to trend nominal GDP of approximately 4.5%. I don't think this is going to last more than 3 months, and we might slide by without it, especially if the government starts buying up more debt, buying up some more of these MBSs.
Lee, the trend since 1973 is actually 2.9%, which is what we've got right now. So if we get the kind of numbers you're talking about, hallelujah, I only pray that happens.
Well, I don't know.
Hey, listen, I always hassled you as being, too rosy on the market. Now I'm going to hassle you about being too bearish. I'm going to take, your side last year. I think the market goes higher here. I don't think we should be worried about the numbers that came out today.
All right. Jim LeCamp, are you out there on the telephone?
I'm watching and listening.
All right. Which side are you on? Are we going to have 4.5% growth, or do we worry about the risk of recession?
I don't see how you can possibly have 4.5% growth with oil prices where they are and with consumers having whittled down to losing their savings rates again. I think there's a lot of issues with the economy. The market, I tend to agree with Don here, the market wants to go higher here. We've seen Treasury yields go back up a little bit. That suggests some money's coming out of bonds into stocks. We've seen emerging markets start to improve. Copper prices have started to come back up along with precious metals, and leadership in the market has morphed. from the defensive type names that we saw in the fourth quarter, like utilities and healthcare, into technology stocks, and much broader beyond that, biotech names. We're seeing a lot more leadership than we've seen over the last 6 months. So the market is telling us, for now, it wants to move higher. The global issues are still there. Europe is still there. It's not going away. We're going to have to deal with these things. It's going to be a trader's market, but the market does look like it wants to go higher.
Well, I will say this, gentlemen. Even though the market was off slightly, let's say for the week, 60 points off on the Dow, some of the cyclical growers like materials, tech, industrials, and consumers, they had positive weeks. All of them were 0.5% to over 1%.
And Larry, the advance to decline numbers really look pretty good. They look better than they've looked in a while.
That's all pretty bullish.
If you look at today's market, the Dow was down, but the S&P, the NASDAQ, and the broad market all did pretty well.
All right, I'm going to leave it there, gentlemen. Thank you very much, Jim LeCamp, Lee Munson, and Don Luskin. Moving ahead, coming up on Kudlow, one of the weakest economic recovers on record. That's right. Now, does that mean President Obama can kiss a second term goodbye? Does that mean he should quit raising taxes on successful earners and investors? What does it mean? Jimmy P. and I will talk right after the break.